Hello, my name's William Burrows. I'm founder of the Annuity Project, and in this video I'm going to give you a whirlwind tour of fixed term income plans. We'll look at what is a fixed term, look at some of the key issues, and look at some examples. So what is a fixed term? Well, it's sometimes called a fixed term annuity. It's a plan where you can invest your pension pot, you can access 25% cash in the normal way. There's an option to receive a guaranteed income for a fixed term. At the end of the term, there may be a maturity amount which can be taken as cash, an annuity, or a drawdown. So this means fixed term income plans have two unique features: guaranteed income payments for a set number of years, a capital sum that is paid back into the pension pot effectively, and can be used to pay income or taken as cash. So is it an annuity or a drawdown? Technically, a fixed term income plan is an option under pension drawdown rules. That's actually quite important, and if you ever come to set up one, the devil's in the detail, and it's important to remember that these are effectively, pension transfers. I have no problem with the term fixed term annuity, but it's important to remember there is no mortality cross subsidy, no income for life, therefore there are no medical enhancements. So how does fixed term work? Really very simple. You invest your money, say you invest 100,000, you can take 25% cash, 75% remains invested effectively in a drawdown plan. From that you can take regular income for a fixed term. The term can be 5 years upwards. At the end of the term, and this is really an attractive feature, and we'll cover this more later on, at the end of the term there's a maturity amount. It can be used to buy a lifetime annuity, another pension option, e.g. fixed term or drawdown, or taken as a cash sum which is taxable. Sounds simple, doesn't it? But the key to understanding a fixed term is to understand the income options, the term, how long it can be, the guaranteed maturity amount, what happens on death. And it's an attractive product, but we can talk about how it fits into retirement planning. Basically, three options for income. Income and money back. This is probably the most popular way of doing it. Instead of purchasing a lifetime annuity with no flexibility, you can have a fixed term which pays a guaranteed income, and you have the flexibility to do something different at the end of the term. You can have an income only plan called a cash out plan. Here you take the maximum income possible. At the end of the term there's no money back. This is fine, part of a bigger pension plan, then that might make sense. The final option is the reverse, which is no income, but all of your money back at the end plus rate of interest. It may sound counterintuitive, but it's a good option for people who want to lock into high interest rates without taking income, but maximising the amount of money they can get at the end of the term. The maximum term is 40 years, which I think is a long time. Probably the most longest term I'd feel comfortable with is probably about sort of 20-25 years. But I do worry about long terms. The minimum term is a year, but a 5-year term is the most popular in my opinion. In fact, I did ask one of the providers and they confirmed that. An obvious point, the longer the term, the more important it is to consider the inflation risk and the fact that you are locked into a long-term contract. The guaranteed maturity amount, this is probably the most interesting and useful option. At the end of the term, the remaining fund, that is the starting fund less any income taken out plus interest, can be paid in a number of different ways. It can be paid as a cash sum, like any other pension income. It'll be taxed at your marginal rate. It can be used to purchase a lifetime annuity on the open market option. It can be invested in a fixed term or a drawdown plan. Technically, you can transfer to another pension provider, and you have all the options available under pension freedoms. What happens on death? This is really important, and it can get a little bit complicated. Um, just like with a lifetime annuity, you get the highest income from a single life option. If you're married, you can have the option for the income to continue up to a spouse or a partner or a dependent at 50 or 2/3 or 100%. Just like a lifetime annuity, you could have a guarantee period, which means that the income is guaranteed to be paid for a fixed period of time, even if you die during that term. There's also an option for value protection, just like a lifetime annuity. It's the original capital plus any income paid out provides a balance which can be paid on death. But you've got to be careful with some plans, unless the guaranteed period is the same as the full term, the maturity value won't be paid out. That sounds quite complex, but let's take a 10-year fixed term. Let's say you had a guaranteed income period of 5 years, but you died after 6 years. In that circumstances, some plans you would lose the option to have a maturity value. So it's really important to take advice and get that bit right. So how do fixed term income plans fit into retirement income planning? Well, the first thing, they can be used instead of a lifetime annuity. So to take, for example, £100,000, if a lifetime annuity pays, let's say, £6,000, you can take 6,000 from a fixed term. At the end of the 5-year period or whatever term, you get some money back and you can use it to buy another annuity. Hopefully annuity rates may be higher, and if you've suffered any health issues, you can apply for an enhanced annuity. You can get a really high income but no maturity value. This is called a cash-in plan. I think the best way of looking at this is, two options. If you have a modest pension pot and you just say, I'm 60, I've got the state pension coming in sort of 6 years, I just want to use this pot to strip it out of income. You can have an income, you can have a plan that pays you the highest level of income and you run out of money. But that's not a problem because the state pension kicks in. The other example would be you've got a substantial drawdown pot and you say, well, I'm going to take a portion of that, I'm going to put it into a cash out plan. I'm going to take the maximum income from this plan, knowing that I'm going to run out of money, but the rest of my pension pot's invested and hopefully it'll grow in value and make up for the amount of income you've taken out of the fixed plan. The third option is an interesting one. It's a bit counterintuitive. I have a good client of mine who knows a thing or two about pensions, and we're using fixed term in his SIP as an investment. So you invest your money, you take no income, the money rolls up. It rolls up at a guaranteed rate of interest. Just like lifetime annuities, fixed terms are priced in reference to the current yields on gilts and fixed interest investments. So if yields are high at the moment, they're running at about 5%. So you can get a guarantee return of 5%. Which is higher than cash, and more importantly, it's guaranteed till the end of the term. So if you were investing in cash and interest rates fell, your interest rate would fall. But with a guaranteed income plan, you're locked into the return till the end of the term. So let's look at some examples. Here we have 4 examples for both a 5 and a 10-year term. The first example is what's called provider default. The providers give a level of income which they assume that if you take the maturity value at the end of the term, you can buy a lifetime annuity to get the same income. So 5,300 for a man or a lady age 65 with £100,000. Option 2 is the matching the lifetime annuity. You can get £7,400 a year gross for a level annuity, and you could take the same income from fixed term and get either £86,000 back after 5 years or £68,000 back after 10 years. Option 3 is the cash out plan, and you can see here you take the maximum amount of income, so £100,000 would pay you £22,300 for 5 years and no maturity value. Over 10 years it's £12,600. The last option is this so-called no income maximum maturity value. So over 5 years, 100,000 would grow to 129,272, and over 10 years to 165,000. So looking into 5% return can be quite attractive. Don't forget, if you want some annuity examples, send me an email or give me a call, and I'll be more than happy at doing a comparison for you. So in summary, guaranteed income for a fixed term, option for money back at the end of the term, that's the guaranteed maturity value, and you have a choice of income and death benefit options. Just like lifetime annuities, fixed term are covered by the Financial Services Compensation Scheme, so they're 100% protected. That's all. Thanks for watching. If you want any more information, please go to my website www.annuityproject.co.uk. Thanks for listening, and be sure to watch out for the other videos.